Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of finance and business, or as we like to call it, we make your brain hurt slightly less. Get ready because Super League Enterprise Incorporated just dropped their Q3 2025 report, and it is a doozy of financial acrobatics, debt restructuring, and a whole lot of hope for the future. So let's dive into what this report for the quarter ending the 30th of September 2025 really means for a company trying to make brands playable. Think of this as a financial superhero origin story with all the plot twists and challenges. Before we get too deep though, if you appreciate getting straight insights from these corporate filings, hit that subscribe button. And hey, we have a growing community on Discord where we break down these documents even further, linked in the description below, so come join the conversation. Alright, the big picture here is Super League Enterprise Incorporated is reporting its latest financial health check for the quarter ending the 30th of September 2025. Things are active, they've got a lot going on, from refinancing debt to issuing new stock and navigating a competitive market. Looking at their current assets, it stands at $4.5 million for September 2025, down from $5.8 million in December 2024. This dip in readily available cash and short-term assets is often a sign of either spending money to grow or, well, just not having as much cash on hand. On the flip side, their immediate liabilities like accounts payable and accrued expenses are sitting at $9.6 million in September 2025. That is actually down slightly from $10.4 million at the end of last year, but it is still a significant chunk compared to their liquid assets. It means they owe a lot of money in the short term. Now, the really big number here, their total stockholders' equity is negative, standing at a deficit of $2 million as of September 2025. This is a pretty stark indicator. For context, in December 2024, they actually had a positive equity of $170,000. This shift from a small positive to a negative equity suggests they've been burning through capital faster than they've been generating it, or perhaps have had significant non-cash accounting adjustments affecting their equity. It is like owing more than you own, which is never a comforting sign for investors. Okay, let's talk about revenue. For the third quarter of 2025, Super League brought in $2.4 million. That is a pretty big drop compared to $4.4 million in the same quarter last year. That is almost a 45% decrease. This is a significant warning sign. Digging deeper into revenue, their publishing and content studio revenue took a massive hit. It fell to $1.4 million in Q3 2025, down from $2.6 million in the same quarter last year. That is a 47% drop. Imagine your main product line suddenly becoming almost half as valuable. And then there is their direct-to-consumer revenue, which has completely disappeared, going from $247,000 last year to zero. This coincides with the sale of their Minville digital property. While selling a less profitable or non-core asset can be a strategic move, it visibly impacts the top-line numbers. Now, you might think with revenue dropping so much, costs would follow suit, and they have to some extent. Cost of revenue did drop by 50% to $1.3 million. This is good to see that they're cutting costs related to producing their services, but the revenue still dropped more significantly. Their gross profit, which is revenue minus the direct cost of generating that revenue, was $1.1 million in Q3 2025. That's down from $1.7 million last year. The good news is that as a percentage of revenue, their gross profit margin actually improved to 45% from 39% last year. This suggests that the revenue they are bringing in is more profitable. They're making more money on each dollar of sales, which is a positive sign amidst the revenue decline. Operating expenses are where things get truly interesting. Total operating expenses for Q3 2025 were $4.1 million, a decrease of 20% from $5.2 million last year. This is mainly due to cost cutting, which is definitely needed given the revenue situation. But look at this. Non-cash stock compensation expense jumped significantly. It went from $356,000 in Q3 2024 to $613,000 this year. That is a 72% increase. This means they're giving out more stock and stock options to employees, likely to retain talent or as part of compensation packages. But it is diluting existing shareholders and is a non-cash expense that still impacts overall value. Interestingly, their general and administrative expenses actually decreased a bit, down 9% to $1.8 million. This shows they are trying to trim the fat in overhead operations. When you put it all together, their net loss from operations remained alarmingly high, at $3.1 million for the quarter, basically flat compared to $3.5 million last year. Even with lower revenues and controlled operating expenses, the decline in top-line revenue means they are still losing a lot of money just running the business, before even considering interest and other financial costs. And the bottom line, their net loss for the quarter was $3.6 million, which is almost identical to the $3.6 million net loss recorded in the same quarter. Last year, it's like they're stuck in a loop, not making progress on the overall profitability. Now, look at the earnings per S-Hair. It's $3.25 for Q3 2025. That sounds great, right? But this is heavily influenced by the preferred stock dividends and deemed dividends, especially the ones related to exchanges. If you strip away those accounting adjustments, the net loss per hair for the quarter is actually negative at $3.27. This is classic financial engineering where the reported per share numbers can be misleading without understanding the footnotes. Looking at the cash flow statement for the 9 months ended the 30th of September 2025, they used $6.8 million in cash from operations. That is better than the $8.2 million they used in the same period last year. So some progress there. They are bleeding less cash daily. But how are they funding things? Financing activities are huge. They brought in $7.6 million from issuing notes payable, meaning they borrowed a lot more money. Their cash on hand at the end of September 2025 was $1.1 million, down from $1.3 million at the start of the year. This means despite borrowing more and cutting costs, their overall cash pile is shrinking. Now let's talk about debt. Their promissory notes payable as of the 30th of September 2025 total $3.3 million, more than double the $1.7 million from December 2024. This increase in debt is a direct consequence of their ongoing operations and financing activities. More debt means more interest payments and higher risk. And check out the YRP warrant liability. Its fair value went from $1.9 million at issuance down to $865,000 by September 2025. This is a gain on paper, meaning the value of these warrants has decreased, which is good for Super League. It's like a debt that's become cheaper to manage. But here's where the story really gets interesting. This report is for the 30th of September 2025, but a lot of crucial stuff happened after that. In October, after the quarter ended, they closed a massive PIPE financing, raking in $20 million. This is a lifeline, especially considering their negative equity and shrinking cash. They are using this money to pay down debt and fund new strategies, which is smart. They also converted $1 million of Bello debt into common stock and got some warrants. This is a classic debt for equity swap, basically turning what they owe into ownership for the lender, which can be a good way to reduce immediate cash pressure. Then there is the yield point exchange agreement. They swapped out more debt for Series C preferred stock and warrants. This is another move to clean up their balance sheet and manage their debt obligations. Remember that Mineville sale, it happened in May 2025, bringing in $350,000 cash. While not a huge amount, it shows they are pruning assets to stay afloat. They are also retaining some rights for ad sales on related servers, which is a good move to keep generating some revenue from that past asset. And the big news in May 2025 was the acquisition of Super Social. This is a production studio and creative agency that is big on Roblox. This acquisition signals a clear strategic push into building out their content creation capabilities and partnerships. It is a bet on growing their presence on these gaming platforms. Looking at Super League Enterprise Incorporated right now, it is a company in a major transformation. Their revenue is down significantly, and they've swung from slightly positive to negative equity. This is concerning. However, they have been very active in addressing these issues. They've cut costs, refinanced and exchanged debt for equity, and secured a substantial amount of new funding post-quarter. The acquisition of Super Social shows a commitment to their core strategy of playable media and brand partnerships. The big question remains whether these recent financing and strategic moves are enough to turn the tide and lead to sustainable profitability. The stock price seems to have reacted positively to the PIPE financing, but there is a long road ahead. They are making smart moves to manage their immediate financial pressures. But the core challenge of generating consistent, growing revenue remains. Alright, that is our breakdown of Super League Enterprise Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. We're building a great community there. Thanks for watching. See you next time.